The game of financial stability and financial independence is basically won by optimizing every single dollar that comes in, every dollar that is stored, and every dollar that is deployed back out into the economy. It's gotten so complex to understand how to stabilize your finances, how to grow to a point of financial independence, because we have so many different products and services, because of so much marketing, etc. We've gotten past the fundamentals of really what makes and breaks being financially successful. It's making sure that every single dollar is optimized, whether it's coming in, whether it's being stored, or whether it's going out. And this is why having portfolio of quality banks for every single dollar you earn and spend is so important. It sounds very, very rudimentary. It's not talked about very often, but I'll be honest, as somebody with a career in retail banking and financial services, I've worked in various forms of financial services and lending and banking for over 13 years. I can tell you firsthand that people are winning and losing based on the quality of their banking relationship, understanding cash flow management. That's what I'm going to teach you in this video. For all my pioneers, this is for all of you as a whole, and anybody else new catching this video. We're going to discuss what having a banking portfolio is, what it looks like, how it's meant to serve you, how you should shop for banks, and how to set up your finances around your banking relationships, how to be strategic about it, whether you're just starting out with finances, whether you're in the middle of your finances, whether you're recovering from something, financially speaking, or you're at the stage of retirement. This is all going to be applicable for you. So the first thing that we need to discuss is, obviously, I'm hoping and assuming that everybody that's watching this is going to have an income coming in. Making sure you optimize that income coming in to be specifically tailored to serve you in every capacity possible. What does that mean? Because that's kind of a mouthful. What that basically means is, when my money comes in, I want to make sure that every single dollar is accounted for. And I want to make sure what needs to be stored is stored at the highest level, and what needs to be spent is spent in the most efficient level. When you are doing your banking, you have got to stop banking arbitrarily. You have got to stop picking a bank based on what one was closest to you, or the one that was handed down by your parents, or the first one you got when you first started working and you never left them. That has to stop if you want to make sure that your money is doing for you what it's supposed to be doing. Because every single bank has enough products and services to make sure that when your money comes in, that it's coming in as fast as and efficiently as possible. When you decide to deploy that money out to spend, that you're spending it as efficient as possible. This is where credit cards usually come into play, because not only do you want to make sure that you're paying people efficiently, you're paying companies and paying for your services efficiently, but really optimizing that is going to be making sure that you're getting some money back on that. And that's why credit cards are so critical to any healthy financial portfolio. When you're saving, when you finally decide what of this money you're going to take off the top for yourself, which ideally I do support the concept of paying yourself first, you want to make sure you're saving in the most efficient manner. Every single bank does not serve every single one of these capacities. There's going to be financial institutions where your money coming in at, they're going to be the most accessible. They're going to have the best technology that allows you to move your money around in different places you need to move it, etc. But that same bank is not going to have the best place to store your money. They may pay horrible on their savings or CDs. The same banks that pay really well in their savings and CDs may have poor credit card lineups that don't allow you to get the most cash back or the most rewards on your highest spend categories. This is why it's so important to build out a portfolio of banks. It's the same concept of building a stock portfolio in balance. If you have a real estate portfolio, etc., this concept is understandable in almost every arena with finances, except when it comes to the very center of your finances, which is cash flow management, which is your banking relationships. So let's give a scenario of what this should look like, and you can kind of apply this to your personal finances and make it work for yourself. When you have money coming in from your payroll, from your business, whatever the case may be, there's a couple of things that you should be looking for and making sure that you're getting the most out of your money coming in the first place. You want to make sure that bank is accessible, not only locally to you, but again, for an example, I live in Southeast Louisiana. We are worried about every June through October. The biggest thing on our minds, environmentally speaking, is hurricane season. Every single year is a gamble that we can either end up evacuated for a short period of time, or potentially temporarily, or potentially even permanently displaced. Think about your banking relationship. Think about your direct deposit coming in. and bank and having that money come into an institution that's only local to your region when you just got pushed out of your region due to some kind of inclement weather or severe storm circumstances. Just that quick, you potentially don't have the right access to your money at the time when you honestly need it the most. Because now you're possibly paying for rental cars, you're paying for hotel rooms, etc. You need your money more than ever, and it's locked away at an institution that you can't access because you're 2, 3, 4, 5, 6 states away from home. So that is one example of accessibility. So not just locally, but it can go with you almost anywhere in the United States, and you can still access your money at the highest level. That is ideal for your money coming in. So an example of that for me is going to be Chase Bank. That's going to be a bank that's in like 47 out of the 50 states that are available, or 46 out of the 50 states. 9 out of 10 times anywhere I go within, call it an hour or so or X amount of miles, I'm likely going to be able to cross paths with a Chase Bank. So that's an example of an institution that has accessibility. That's also an example of an institution that's going to have technology. So if I cannot physically visit their branches, Chase Bank is going to allow me the technology to send my money peer-to-peer. It's going to allow me to hook up any other financial institution as an external hookup that allows you to move your money into different accounts because you may be paying your bills through different banks for various reasons. Chase Bank is going to be one of those examples. Bank of America could be another good example of an institution that has the technology and branch footprint to go anywhere with me and allow me to move my money that is coming in anywhere I need to disperse it, no matter where I am, for the most part. That's an example of building. That's the crown jewel, if in a sense of speaking, of your banking portfolio, is having a bank that will go almost anywhere with you, whether it's physical footprint or technology. The next thing you want to worry about, ideally, is where you're storing your money. Ideally, you're going to be saving some portion of your income when it comes in. You need to make sure that you have access to an institution that's going to give you the most earnings on your savings, even if it's not invested. So that basically can mean high yield savings account, basic savings accounts, or various forms of CDs. Chase Bank sucks in this department. So this is an example of what I'm talking about. Now this is where my Navy Federal, where my local credit union, my community bank, or small regional bank is going to come into play. They're not going to be the best option for me for my main direct deposit, because if I have to go 5 or 6 states away for a hurricane in my scenario, I can't easily access even Navy Federal. That's all across the country. They usually only have one branch per city or per area or market that they're in. And any smaller local institution, whether that be a credit union or small bank, not good for accessibility. But if I tie it to my Chase Bank account and I have access to hooking them up externally, and now I have somewhere when it's time to save 10, 15, 20% of my income or more when it comes in, I can put it inside of that financial institution that gives me 3, 4, 5, 6% on my savings, my CDs, whatever the case may be at the time of this recording, whatever that case may be. Listen, saving and deposit products is typically not the most advantageous thing, but you need to park your money somewhere until you find a more efficient way to deploy it. Real estate, life insurance policies, stock portfolios, businesses, whatever the case may be, these are all more complex financial strategies. You still need somewhere intermediate to park your money and still get decent returns. So that's going to be where I'm going to fill out my store of value for my money until it gets deployed somewhere else that's going to give a better return that might beat out inflation. Next is going to be where I'm spending. Now, this is where you might end up being able to go back to a Chase Bank or a Bank of America, or you may be in the situation now where you have to go out to some other institution that maybe you don't have within your region or footprint. This is maybe a more of an online access, because the main thing for your spending, of course, out of your checking account is going to be your main financial institution. But this is where I advocate for credit cards. I always say, and I will continue to say, credit cards are a spending tool. They are not a debt tool by trade. Basically, what that means is you don't have to go into debt with credit cards. Credit cards can literally be a positive arbitrage for you when you're strategic about it. That basically means that you use them to spend money that you already have, and you're getting yourself ideally somewhere between 1.5%, 2%, 3%, 4%, or 5% cash back on your money. Now you're starting to trend up, because when your money's coming in, it's coming in efficiently. You're storing and saving efficiently. Now when your money's going out, it's not just going out to pay whoever you're paying and that money's gone. Now I'm getting a little bit of that money back. So when you start talking about the concept of inflation, this is where having a good banking portfolio that has a great credit card lineup based around your primary spend categories, whether that's gas, whether that's groceries, whether that's utilities, anything that you're paying on a consistent basis that's costing you hundreds to potentially thousands a month, you want to have a credit card for it, because ideally you're getting cash back. So if gas is going up 5 or 6%, but you have a credit card that's giving you 2, 3, or 4, 5% back on that gas, this is where you're blunting out some of the effects of inflation and these higher costs. You're optimizing your dollar. When you stop and think about, again, what I said at the beginning of the video, cash flow management, optimizing money coming in, storing, and going back out. This is where you're making sure that you're keeping up with the financial environment around you. There's products for almost everything. Even if you're at retirement, you should be banking at financial institutions that are offering you the ability to have full-scale retirement services. Again, for me, that might go back to Chase Bank. Navy Federal has their own branch of that. But there's different institutions that are probably local to you that have wealth management, private banking, and these other retirement and wealth management systems attached to that financial institution. I don't want to have to break off and have my retirement over here, this over here, that over here. I want a handful of banks that are going to work systematically together, that I can link all of them together and have my money flow through that ecosystem and take care of all of my income needs, storing needs, savings needs, spending needs, retirement needs. If I'm in business, I want to make sure that my business is in that same ecosystem. Every single bank, I am imploring you towards the end of this video right now to analyze every single banking relationship you have and why you bank with them. If you stop and analyze every dollar you're spending, where you're saving, and how your money's coming in, or is it checking the markers I laid out in the example that I gave you? Is all of your money accessible, or the bulk of your most needed funds when they come in accessible physically and virtually? Are you able to move your money through these institutions seamlessly because of the technology that they're offering? Are you able to store at least in one of these institutions or more at the highest rates available without having to jump through a bunch of hoops? Are you able to spend efficiently by having at least one or more credit cards that takes care of all of your major spending needs? If you're at a retirement stage, or if you're early planning for retirement, do they have retirement services available within that institution that can tie into your relationship banking? If you operate or plan to operate a small business, do they offer the small business deposit, cash flow management, and lending products that you need to optimize the same ecosystem for your business? This is what this looks like. I promise you, without having to go through any crazy financial products or strategies, if you optimize what I'm laying out for you in this video, 9 out of 10 times, you're going to be at least financially stable. Guarantee it. Comment down below and let me know what your current banking portfolio looks like. And every metric that I laid out, I want you to tell me, do you check it off? Are you missing something? What did I make you think about when I laid this video out? And if you do have all of these boxes checked, drop the institutions that you're banking with down below and which boxes they're checking for you, so I can get that you understand what I'm laying out for you. If you don't understand and have more questions, comment that down below. Let me know if you're lost on, well, how do I find these different institutions? I'll shoot an entire video about that. Comment it down below. To all my newcomers, welcome in. To all my pioneers, welcome back. I want each of you to keep supporting this channel so this channel can keep supporting you. You know how to do that. Like, comment, share, and subscribe. That's easy strategies for you to make sure that this kind of content is not only keep coming to you to help you level up your finances, but it's getting out to other people who need access to the same financial resources. To all my pioneers, I want each of you to stay focused, stay in motion. I'll see y'all soon.